Welcome back, ladies and gentlemen. The next panel discussion for the day begins now. Let me invite our eminent panelists. We have with us Mr. Mitul Patel, Senior Vice President and Fund Manager, IIFL Asset Management. Mr. Patel has 14 years of experience across areas of research, fund management, private equity advisory, and investment banking. And apart from managing the strategies of portfolio management services offered by IIFL AMC, he also heads research for listed equities and is responsible for generating investment ideas across sectors and market capitalizations. Ladies and gentlemen, we have with us Mr. Trideep Bhattacharya, Senior Portfolio Manager, Alternates, Axis Asset Management. He comes armed with over 20 years of experience in equities and portfolio management in India and other Asian emerging markets, as well as developed equity markets. Before joining Axis AMC, he spent a significant time as a portfolio manager at State Street Global Advisors and with UBS Global Asset Management in London. We have with us Mr. Madanagopal Ramu, Fund Manager, Sundaram Alternates, and he is the Fund Manager for PMS and Alternative Investment Funds Category 3, with around 14 years of experience in the Indian financial markets. He currently manages an AUM of rupees 1,835 crores and has over 4 years of experience in managing funds. He's a qualified cost accountant and has a management degree from BIM Trichy, in fact. We have with us Mr. Sachin Shah, who's the fund manager of MK Investment Managers. He's a seasoned fund manager with over 2 decades of experience in the Indian equity markets, with over 2 decades of equal EIML's proprietary module, which actually helps to evaluate and compare listed companies on various aspects of governance. He shares his knowledge and insights through various media interactions across print and digital platforms. So these are our eminent speakers, ladies and gentlemen, our panelists, and I extend a very, very hearty welcome to them. They are going to discuss what philosophy will create more wealth over the next decade: growth at reasonable price, or growth at any price, or value investing. And the session will, of course, be moderated by none other than our very own Mr. Sankalpo Pal, one of the core members of the team PMS AIF World. Mr. Pal, warm welcome.
Thank you,
he takes care of business development with the PMS AIF World. I'm requesting you to please take over the session, sir.
Thank you, Aishwarya. So this topic and session is very close to my heart. These are all very dear friends of ours, and at various points in time we have interacted with them earlier, and we thought they'd be the apt guys to talk about what philosophy of investment will create wealth in the next decade. So why philosophy is very close to us? Because we have a proprietary at PMS AIF World. We have a proprietary 5P process or 5P philosophy of fund manager selection. The 5Ps being people, portfolio, price, performance, and at the end philosophy, of course. So again, today is a very special day. ITC closed positive 10% in a week after a very long time. That hasn't happened in a very, very long time. So with that pretext or that context, we'll discuss about philosophy. So at the beginning, I will ask all of you, what do you understand by investment philosophy? So Sachin, if you can take that first, and then maybe Mitul and Trideep, and then Madanagopal. The first question is, what investment philosophy means to you, and how do you practice it? Over to you, Sachin.
Hi, thanks, Sankalpo, and hi to everyone. Sankalpo, let's be very clear about one thing, that what's really the fun of investing, fun of equity investing, right? So I think the most important thing about equity investing, the real fun is, what Einstein said, the eighth wonder of the world, which is compounding, right? And for compounding to happen, of course, it happens over a period of time. But the important thing also that has to happen over a period of time is that there has to be growth, right? Because if there is no growth, then how much of a time you put in, the compounding can just not happen, right? So from that perspective, I think it's very, very important that growth has to be there. At the same time, it's very important that everything is good at a price and everything is bad at a price, So, investing in businesses where there is growth, and particularly in the Indian context where, the Indian economy is all about growth. Indian stock markets respect the most where there is growth, for the right reasons, I would say. So from that perspective, I think it's very, very essential that, and even if you think about it, right? If you take a little longer view, right? If something doesn't grow, but if everything else is growing, then even if you bought something cheap, but over a period of time, relatively, because everything has grown so much, that this will actually look little expensive because you've actually stagnated there in terms of the business growth or whatever you look at, think about it. So growth is definitely very essential. But at the same time, one has to be very clear that buying at extraordinarily high valuations is not going to make you money. So the risk reward is something which is an art, which is an important thing that we are trying to address in this session, I would like to think. So, to my mind, buying businesses where there is growth, but at a reasonable valuation is something which is very, very important to my mind. And of course, then there are certain philosophical things, which is something like I would never want to compromise on the management quality, invest in businesses where there is inherent strengths of their, as far as their profits is concerned or the business strengths are concerned. So those things are obviously there, but at the same time, the risk reward in terms of your purchase price is also going to be very critical.
So before we move on to Mitul, so you would say philosophy is essentially a checklist for you?
Well, it's a combination of a checklist. So as you rightly said, actually if you think about it, investing is a combination of science and art, right?
Right.
So the checklist is part of that science, right?
Right. Hold that thought. Sachin, will come back to you. We'll take it from Mitul here.
Yeah, thanks, Sankalpo. Actually, I agree with what Sachin is saying. So investment philosophy to us at IFL, is basically we call something our investment framework, something called the SCDV framework. And what is of investment philosophy, right? It's basically a guiding principle. And underneath the guiding principle is something that at least we have tried to work really hard on is process. And during wavering times, how strictly you follow that process. And we are more growth biased as well as as Sachin mentioned, but we are more focused on profitable growth. So generally 40 to 60% of our portfolio is things that can grow earnings greater than 15% with greater than 15% ROEs. And that is basically our core investment strategy, and that is something that we will stick with for a long period of time. And we are also believers that something that has worked for the last decade or last 5 years is not something that's always going to work in the future. And that's why we have tactical bets, based on something that we can put a value on and something that is available at a price which is below than what we think it's worth. So that is something that we are constantly playing with. So 40-60% is something that is secular in nature for us, and the balance is a tactical bet in terms of how we allocate money. But I think something very important, I think a lot of people have learned this lesson, including us the hard way, is that in long-term investing, I think everybody can pick good stocks, manage good portfolios. I think, but the really important thing is to avoid mistakes. And I think we have something that we are always going to be underweight or really avoid value traps. The way we define value traps is businesses that are really broken business models, questionable management, and things that have not generated 15% growth or ROE over the last 10 years. So something that we kind of shut our mind towards and not focus our energies on those kind of businesses. I try to fight bargains there. So I think it's a combination of how you manage your portfolio and stocks over the long period of time with a growth bias, and really avoid the pitfalls which we call value traps.
Thank you, Trideep. Let's take your view on investment philosophy.
Sure. First of all, a very good evening to all the viewers. Wish everyone a very happy new year, and hopefully all of you are healthy and safe. Before getting on to this, I was actually looking at Investopedia as to how is investment philosophy defined. And really interesting, they define investment philosophy as a set of beliefs and principles that guide investors' decision-making process. And I think that is a very apt definition of why that is. But for people who are listening to this, I would like to simplify even further. I would say that it's a bit like an elephant. And all of us are like blind men trying, and the elephant is the art of money making. And we touch some part of the elephant, and we think that that is the way to go about making money. And obviously, the fact that we have been doing that successfully for a reasonably good period of time shows that it works. And but at the end of the day, there are many ways to sort of skin the cat, or many every part of the elephant is also an elephant. It is just that what we touch or what we understand, what we practice, turns out to be reality. What I'm trying to bring in is a bit of a fluidity around what investment philosophy really means. In other words, there could be multiple ways to generate money, or to, not to generate money, to make money from equities. So these are not laws, but guidelines, and hence evolution and adaptation to the current circumstances versus being regimental is very important. But having said that, we at Axis actually, of all the various ways to touch the elephant, we touch the touch the bit which we understand, or I understand, over a period of last 25 years, which is the moat around brands. And basically, to understand the mode that brands bring along with themselves, with the business that they're in, and how that evolves over a period of time. And it's kind of it's a specialized theme. It's a kind of it's kind of a, call it a philosophy or a theme, which brings its own set of discipline principles and its own fallacies, which needs to be kind of checked in and checked out on a regular basis, to sort of see whether we are on track or not. If I were to sort of bucket myself with regards to the traditional ways of classifying, the investment philosophy as value, growth at a reasonable price, etc., I'll probably say, quality at a reasonable price is the way, or growth and quality at a reasonable price is what I would say it stands for. But really, we believe in the power of brands at Axis. We think that brands, along with it, over a period of time, have a moat which expands if sort of executed properly, and along with a checklist of things that one could go wrong, both behaviorally in terms of decision making, or the company in the form of steps that they take to create a brand, or maybe spoil a brand. I think could be a very good potent theme for wealth creation for investors over a period of time. So that's what I would say as a that's what I understand of investment philosophy, and that's what has worked for me, and that's worked for Axis for a good while, and we stand for that.
Thank you so much, Trideep. Madan, over to you now. What's your view on investment philosophy, please?
Thank you, and hi to everyone in the panel as well as all the clients. I think the other panelists have covered most of the points, but I think the first point that we believe when we define our investment philosophy is equities and growing asset class. And there is value only if there is a growth. And if there is no growth, then there is no value. And that's something which we keep it very close to our heart. So prima facie, companies with good growth prospects, in our view, have a value. And what is a reasonable value? That depends on what price you buy that stock. So that's where the important point comes in. But importantly, when we talk to investors, what we always emphasize is what is the return that they are looking for from what investment horizon, and that should align with the investment manager. So when we bring in investors, we emphasize on making them understand that you need to come in with a period of at least 5 years. That's the investment period that we minimum ask our investors to come in, and look for value creation or wealth creation over that period. So it's clearly about buying stocks now, which will match that investment period, and what kind of targeted return that we are trying to give them. And basically align the investor's expectation with your investment strategy. And that's the important point, and need to follow it consistently. There is no other better time than discussing today about the value and growth investments, right? So it's become a hot topic. Everybody's writing about it these days. It's important that you follow your philosophy consistently and look at what has happened in the last 10 years. What strategy has created a meaningful wealth to the investors over that period, and what is your strength? It's not like a fund manager can be good at both a value pick as well as a growth pick. Both requires a completely different thought process and ability to act in different market conditions. So you need to understand your strength and you need to align the investment returns and the investment period that you are targeting to generate that wealth with the expectations of the investor. If this is set right, then I think there is a lot of chaos that you reduce, and the philosophy will be much appreciated by the investor, as well as things becomes much easier. So we follow in that way growth at a reasonable price, which is generally defined as GARP. What is reasonable price? To arrive at, it's a science and art. It's not a scientific method of putting some numbers. But important thing is we lay a lot of emphasis on three aspects. We look at companies from a futuristic point of view. We believe that structural trends are possible. So therefore, look at each business from the next 5-year point of view and try to bring down our numbers in a discounted cash flow methodology. When you do that and then arrive at a reasonable price, that's in our way is a better way to look at. So in that way, you can even justify Titan's valuation today. And we have been having this talk for a very long period. Many people ask us, how can you justify a 50 times PE stock? But if you do the DCF and compare, so basically it's about looking at the future cash flows and using the right equity risk premium and then the right terminal growth. These are certain things which are not common for all stocks, right? You cannot put the same equity risk premium and the same terminal growth rate for all the stocks that you have, all the sectors that you have. So that's where the art comes in. That's where you need to bring in that mix of both science and art of valuation. It's not an easy thing, right? That's why we are the fund managers are paid for. So that's where most of the time it goes in to judge the right price for the right stock. But it's important to align what you want to deliver to the investor with what the investor's expectations are. That's where the philosophy starts.
Right. Thank you, Madan. So I really like what you said. Where there is growth, there is value. Where there is value, there is growth. So, I mean, I might have mixed it up a bit, but I really like that quote. So, like Trideep, used Investopedia. There's a big advantage that Investopedia has, that it can be theoretical, while you guys can't be most of the times. You guys have to be more practical and out there. So, let's just take some time. We'll begin with Mitul this time. Maybe you can just tell us about the philosophies that you think have worked and will always be relevant. The reason that I'm asking this question is that there are a lot of newer kind of companies that are coming in, and that we call this session the crystal gazing 2.0. There is insurance that is coming in. There are a lot of technological companies that are coming in. There'll be various things that come in. I mean, who knows, a co-working space gets listed, and then how do you value these? Okay, so on the wake of these, Mitul, maybe you can tell us what philosophies work, what always stay relevant, or like you said, art and science. How do you play a bit around there? Maybe we can take Mitul's and then Sachin's view on this, and we'll see. Over to you, Mitul.
Sure. So as you mentioned, I'll take this the first part of the question. We are looking at, we have all been fascinated by the meteoric rise of tech in the US. I was reading an article recently, is that I think collectively the FANGs plus a few companies, other companies collectively have $220 billion of cash flow, give or take. I don't remember the exact number, which is growing at 25% CAGR, right? So, and collectively their market cap must be 3 trillion, 4 trillion or something, right? So these are really large companies, that are growing really, really fast, much faster than perhaps our Indian companies grow, who trade at 50, 60, 70 PE. And it's also because of the fact that, I was looking at, Microsoft earnings. Now the revenue from the Azure business, which is the cloud computing business, is much more than the traditional Windows license business, right? And if you would have done some sort of crystal ball gazing 15 years back to try to arrive at some value of Microsoft, there's no way you would have plugged in an Azure that would have been as big as that, right? And to put it back into Indian perspective, let's look at 15 years back. You would have looked at Page Industries. It was like, oh, it's jockey, it's India, it's just for men, etc. Right? It's just 50. Let's say 50% of the population is the target market. Now, I mean, they do kids, they do women, they do everything, right? So the addressable market has just doubled over a period of last 7, 8, 9 years. So I think what's going to happen now going forward is, the addressable market, for these companies that are in the technology space, and I think how technology has become a large part in India, in the US. I think in India it's going to be financial services. And though these financial services companies, banks, NBFCs, etc., are doing quite well, I think the addressable market for them is humongous. I think that's one of the only spaces where they can grow, 15-20% for a long period of time, and where these companies are much larger companies and growing profitably. And I think the share of financial services in the benchmark, in the market cap of India, is going to just keep on rising. So I think there's a large addressable market that really fascinates people. Sometimes certain technology companies don't make money, but Amazon didn't make money for a long period of time, and suddenly they started making money. So it's about when will they start making cash flows, at what period of time. So I think, but they keep on growing at a very fast pace as well. So I think that's really more important in terms of how big the sort of addressable market is, and how you're going to value that going forward is going to be a little more important, I would say.
Thank you, Mitul, for that. Sachin, can we have you take this question? So, the two-part question: what do you think? What philosophies will work going ahead, and how do you evaluate new businesses that come in to the Indian listed space? Over to you, Sachin. You're on mute.
Hi, sorry. Yeah, Sankalpo, thanks for that help. Yeah, so let me start by saying that what has worked for me in the last decade, and there are times when you are right for the wrong reasons, you are right for the right reasons, you are sometimes wrong just because you were doing something wrong, and sometimes you're wrong just out of bad luck. But in the last 10 years, if I see my successful portfolio holdings and versus the not so successful portfolio holdings, one distinct trend that I see, and what has worked for me in the Indian equity markets has been the management. To me, that has been really the key thing. Like, for example, when I talk about management, we evaluate all the three parameters of management. So management integrity, management strategy, and then the management in terms of their execution. Like, for example, the business opportunity is there for, if there's a large business opportunity, it's there for many companies. Like, if you go back to the year 2000, the IT as a space business opportunity was there for everyone. But it's just about 4 or 5 companies who have scaled it up to the level where today they are $1 billion, $2 billion plus kind of profits, right? So it is where Infosys, TCS, HCL Techs, Wipros of the world, where the integrity, the strategy, and the execution all played out absolutely brilliantly, right? Because first is, when I talk about integrity, it's about, the way I look at it is that managements which haven't compromised on the minority shareholders, not only minority shareholders, but who have been very fair to all their stakeholders, right? It could be employees, it could be the suppliers, it could be the customers, it could be their shareholders, all of them. So that has played a very important role in terms of actually the wealth creation over a period of time. Strategy, again, getting the big picture right, because I have seen many times where managements do not get that big picture right. They sometimes miss the entire the woods for the trees. So that getting that big picture, that big vision, having that getting that right is also very, very critical. And then you talk about the execution, right? Because even if you are have the big picture and big vision, but unless you actually execute to the last point, all of just remains in theoretical. As you rightly said, it's all about practical. So to my mind, one of the big differentiators has been the management, which has really made big differentiation in terms of the successful businesses, or even in terms of wealth creation for the investors. So that has really worked for me, and I would like to think that will continue in the Indian context, where it's all about entrepreneurial spirits, right? Because let's face it, I mean, there are so many headwinds, there are so many hurdles when you want to run a business in a country like India. And yet some of these guys have actually grown their businesses in a significant fashion. They've scaled up businesses. Like if you go back to companies like Pidilite, Asian Paints, DV's Lab, Sun Pharma, I mean, across sectors, banking, Kotak Bank, I mean, across each of these sectors, you will find 2, 3, 4 guys, or maybe sometimes 5 guys who have really scaled up these businesses in a very profitable way again. And against all the challenges that the country offers, because there is really no great support as an ecosystem. Like for example, in the US, you will have a very great ecosystem for the startups, but nothing of that sort out here we have. So it's their entrepreneurial spirit, it's their acumen, which is actually creating wealth. So for me, I think that has been one big learning of last so many years, that it finally all boils down to the management. Of course, the business opportunity, inherent profitability of the business, all this is there, but that's available to many people, right? What DV's has done in the last 15-20 years, that opportunity was for a lot of people, but it's only him who has been able to capitalize on it. So to my mind, management quality plays a very, very important role to me.
Right. Thank you. So, ladies and gentlemen, this is the beauty of bottoms up philosophy based stock investing. You can bet on people who run the show, who can run the business. This is something very unique to our profession, and very well said over there, Sachin. So, Madan and Trideep, I have a different set of questions for you. Sachin and Mitul, I'll come back to you in a while with a few follow-up questions. So, Madan and Trideep, I have gone through a lot of your product collaterals and a lot of client interactions done with you. So one thing that I've realized is that your portfolios or your style of investing have a inherent moat based style of investing. So how do you see that? We have seen, like I talk about this to a lot of people. The Swiss once upon a time had a complete kind of dominion over luxury watches. So today there's an I watch that you can buy and you can be equally luxurious, or there are so many other options. So modes might have some, modes could see some disruption. So how do you address that kind of a philosophy based investing? Maybe Madan, you can take that, and then Trideep.
Sure. That's a nice question actually. And see, one of the, I think Sachin covered it. He spoke about getting the big picture right. I think I spend a lot of time on getting this big picture right. And I think that's where a lot of differentiation can be brought in the way you pick the sectors and stock, and wealth creation can be meaningfully different, in my opinion. And the practical way of doing it is to look at the macros. Where is the Indian economy at this stage, and where it is poised to, and be very unbiased and be very careful about your expectations on the economic front when it comes to what is happening in India at the macro level, and then probably try and fit it into other economies, and also look at sectors in other economies, how they've evolved over that period, and look at what is happening at this point of time, and I spend a lot of time reading about what is happening in those sectors globally at this point of time, not just restrict my reading only to Indian companies and what they do. For example, I used to be a infrastructure and capital goods analyst. I spent a lot of time at that point of time in understanding what is ABB and Siemens doing globally. Because once you understand that, it becomes easier for you to get the big picture right. And at that point of time, it was clear that globally, technological advantage of being a transformer manufacturer is coming down quite rapidly, or a switchgear manufacturer is coming down quite rapidly. And Europe, what has been the strength of Europeans has been shifting to Chinese and Koreans, because there isn't any big technological advantage that was coming through at that point of time. And then if you look at the capex story in India itself, has been struggling for a while post 2012. So that made things much easier for me to look at what can I expect in terms of growth from a typical capital goods company in India. And you can see what has happened with Thermax, ABB, Siemens, and BHL over the last 10 years or so. how much of value destruction that has happened. Once you get the big picture right and what is happening globally in those companies, then I think it sets a trend, it sets a platform for you to kind of evaluate companies. In that point of view, if you asked, say, 15 years back, anybody on capital goods, ABB and Siemens, they would have said, have the best moat, right? And you should be blindly investing in them. That moat had no value because the sector itself is losing out to a different sort of so technology when got the back seat, and then the cost effectiveness got the front seat, and then Chinese and Koreans were very strong in that, and eventually it led to a kind of say dying business, you can say. And today they are all fighting to see how they can get out of this business. There was a period when these businesses are so much valued in India and globally also. So that's very important, in my opinion. From current scenario, what I feel is a lot of things are changing globally on the technology side, and you need not be completely an online business to benefit out of it. And particularly from Indian context, I think a lot of this, as mentioned by one of the other panelists also, the private banks and even some of the retail companies, the consumer discretionary companies in India who have an offline presence, and they are all focusing on getting their online structure right, their supply chain management right. These will create strong advantage to these guys compared to the competition. And most important point for this is these companies should be able to generate a good return on the invested capital that they have in the business. So it's simply looking at growth opportunities one, but you need to have money at the right point to invest in it, right? So cash flow growth is the primary metric that you need to judge, and incremental ROIC, how much money you can invest into the business and how much return that business can generate over a defined period is a key point to measure, and that we pay a lot of attention. We measure, we say these companies as self-sustaining cash flow generating models. Once you, and it's very rare to find in Indian context such companies. You can find a company which can do it for a year or two, but for you to say next 5 years this business has capability to grow its cash flows by 20%, not many companies can match it. So, and also not many companies who can do it are available at reasonable price. So that's where the key crux comes in, and therefore it in line with what the other panelists said, that the management quality, capability to execute. I think to get the big picture right, you need to look at globally what is happening in each of these sectors and get your thought process clear. And that's where I put a lot of my time in that way.
Right. So for you, moat has to be backed by cash flow. Good.
Has to be backed by cash flow and future prospects.
Right. That's very thoughtful. Trideep, your answer, your take on this now. You want me to repeat the question?
It's been so long, isn't it? No, I'll see what is left. I'll be rather brief. I think I focus generally on the unit economics of the business quite a bit. I think when you think about the moat, there are two things I particularly, or three things that I particularly focus on. One is inherently is the unit economics of the product or the service that they are selling is good enough and can sustain a period of time. I think if the unit economics is not profitable, and I distinctly make the point of unit economics because maybe the whole business at any point in time is not yet making money. But if the unit economics of the product or the service that they are selling is hugely profitable, then overall, at some point in time, the business will truly reflect the unit economics of the business or unit economics of the product or the service. And I think one has to separate the overall numbers that are presented to us by the accountants to kind of get down to the unit economics to figure out how profitable how growth oriented is that particular product is. Along with that, obviously, the other thing that I evaluate very closely in and around the moat particularly is the whole element of disruption. I think in the current era where distribution, etc., is getting disrupted as we speak, we saw one happening particularly during the pandemic, where we are making more choices these days digitally than being physically present there. It's made supply chains very efficient, but at the same time, it has brought disruption to a completely different level. And I think moats in and around the world, not just in India, have been challenged significantly on the back of this. If you think about, business models in and around multiplexes, in and around travel, in and around transportation, those businesses have got disrupted. The unit economics of the business have got disrupted, predominantly because all of a sudden there is an alternate way of doing the business. This is why I talk about I want to any business that I evaluate. Obviously, management quality is an important, as one of the earlier speakers mentioned, but the ultimately you can have a great management and a very crappy business. Eventually the nature of the business will overrule over a period of time. So the unit economics of the business and how easy or difficult it is to sustain, or how easy or difficult it has been for the company to sustain in the face of disruption is key. On one hand, you have Coca-Cola, you have Pepsi, which have lasted for about 150 years. On the other hand, you have pipes making companies which have which have changed technology every 5 years, and we have seen a new set of companies come over. Similarly, if you look at technology as a space, or mobile phones as a space, while Nokia was a bellwether at one point in time, it was substituted by BlackBerry, then Samsung, and then things changed because all of them at that point in time had good management, but at the same time they were not able to battle the disruption that came along with in the business over a period of time. So I think when we talk about modes, and particularly when we are looking to make long dated calls in our portfolios, the unit economics, the ability for the business to face disruption, and third, basically the inherent cash flows that the company is making. And when I say cash flows, I mean ultimately maybe the overall free cash flow of the company is still negative. This is the recent learning from various FANGs that you mentioned initially. But overall, the basic economics of the business are extremely profitable and growing at a phenomenal pace. So if one focuses on that, then sometimes stock picking becomes easy. And this has evolved from Ben Graham times of investing, where we used to call cigar butt investing, to basically Warren Buffett, who has evolved from from just looking at the traditional price value multiple to more moat of the business. And I am sure going forward, looking at as businesses where one needs to invest first, and the later on the market opens up quite significantly. I'm sure the investment philosophy, in general, we have to adapt to all of these levels of disruption that these come about. So these are the 2 or 3 things that I look at when we think about moats, when we think about investing, particularly in the current context.
Right. So what I understand is moat might not be the gospel around here anymore. So you have to determine if moat is backed by cash flow, or the moat can disrupt, or if the moat is sustainable for at least some time. That's good thought on the moat philosophy of investing. So now I will come to Mitul and Sachin. So Mitul, I want to you can take this answer next, because I know you do this as a portfolio practice. A lot of the modern day active fund managers are somewhere diversifying philosophies in their portfolios. Now it might be a coincident, or might be by might be as a practice, where you have some portfolio in the value style, some in the growth style, or different kind of. So what's your take on that, Sachin? And as a fund manager, would you want to look at that kind of a satellite or a core portfolio, and if you do, how is that philosophy helpful to an investor? Over to you, Sachin. Sachin, you're on mute again.
Yeah, sorry. Thanks, Sankalpo. Okay, so yeah, so Sankalpo, actually it's a function of your investor profile, because that really determines your investment strategy at times. So, like for example, what you mentioned about, say, having a core portfolio or a satellite portfolio, or having a very long-term compounding portfolio, and a part of a portfolio which is more like probably some bit of a trading oriented, that kind of a thing. I think it's a function of your investor profile, or how you define your path ahead to your investors. I think that's a function of that. I mean, you can design the portfolios the way one would like to, and I'm sure both works, because what works for you works for you, what works for me works for me, is something what I have learned over a period of time. So I think that it's not about that this philosophy will work or this will not work, but at least when it comes to our style of investing over here, we generally like to stick to the compounders. We like to have the entire portfolio where we strongly believe that each of these businesses, we would like to own them for at least 2, 3, 4 years. And if the businesses are actually performing, we would like to continue to own them for even longer period of time. Because as I said, the real fun of investing is all about compounding. And for the compounding to happen, we have to stick to those businesses for a fairly decent period of time. And frankly, there have been at least 4, 5, 6 businesses in our portfolios that we've been owning for more than 7, 8, 9 years now. In fact, more than 40, 45% of our portfolio today would be 5 year kind of vintage, 5+ years kind of vintage. So we strongly believe that remaining focused with compounding kind of business ideas. Yes, of course, there will be a few instances where things did not play out the way we were anticipating, and that's the time when we will take the necessary course corrections, which is fine. But that was not the intent. The intent at the time of investing was very clear that we would like to own these businesses for minimum 3+ years, and if the businesses keep on performing, we would like to own them as long as we believe the moat is there, the inherent profitability is there, the management is hungry for growth, and there is a large opportunity for them to grow. So that is what has been our strategy all this while.
So you would rather have two different portfolios for two different styles of investing rather than have them together. Point taken. Mitul, I know you slightly will differ from that view of the world. So I'll let you answer this question now. Over to you, Mitul.
Sure. So, we as you mentioned, we have a mixture of things, in our portfolio. But though we are long-term investors as well, but we believe that long-term is made up of a series of medium terms, if you will, right? And I think in terms of, we are very focused on capital protection as well. And I think when we see a business that, we want to own for a long period of time, we also want to actually have the right weight. So we have a lot of focus on, what kind of weight a stock or a business has in the portfolio. We don't want to, where we as a team feel that there is a significant amount of upside in this stock over a medium to long term, but, we have a very small position. So, as Sankalpo, that, some of our winners have been, and our returns also have come, our attribution has come across a lot of stocks, but it is because of the fact that, we have put a significant amount of money to work, in those names. So I think, it's a level of conviction that also kind of builds into the kind of businesses that we own. And we have a mixture because, we feel that, we are growth biased, as I mentioned, but we also feel that, market, sometimes, especially this year, this is obviously, hopefully this year doesn't repeat, the last one year doesn't repeat again. But, every 3 months, there was a different thing that was working, right? But that was nothing to do with long-term fundamentals, right? But the stocks move 50, 60, 70%. So we are trying to capture businesses that, have, long-term great business prospects, but, have catalysts that come through as well. So, good 30 to 40% of our portfolio is in stocks where we think that there is, strong earnings visibility backed by good managements, and have some sort of moat around them as well, and are trading at, prices that is lower than what we feel they should be valued at. And 60% is something that is long term. And, out of our 25 stock portfolio, 8 to 10 stocks have a vintage of roughly 5 years as well. But, we do manage weights quite actively, but the stocks can remain in the portfolio for some time. So yeah, that's how we kind of.
Right. So you are comfortable playing different themes at different points in time. Point well taken. So the next question I'm going to ask is very important, at least from an investor perspective. But each of us will try to wrap it up in, let's say, 2.5 minutes. Okay. So the question is, what does your investment philosophy tell you about exiting a stock? We've all discussed at length about getting into a stock. So let's try to, book profits here because the markets are at an all-time high. ITC भी बढ़ गया, अब और क्या चाहिए बाजार से? So let's see, Trideep, can you tell us a little bit about how your philosophy thinks about exiting a stock or booking profits?
Right. So, by the way, exiting a stock does not always mean booking profits. You would love to go that way, but
I am an optimist, sir.
the, there are ways in our career, and all of us have a reasonably long career where we see multiple things. So, exits are a very important, in my opinion, as we evolve as portfolio managers over time. Buying is relatively easier decision than selling. Selling is a tough one. It comes with over a period of time. But having said that, if I were to distill my selling philosophy in 3 points, I would try to encapsulate that in 3 points. One is where we bought the stock and we had a strong thesis behind why we bought the stock, and the stock worked out well. Every stock that we invest in at Axis, we do have our estimate of what we call as intrinsic value well laid out before we get into the stock. And as the stock, as we see this happily look at that the stock has appreciated to a certain extent and reached the terminal value or intrinsic value, and over a period of time maybe has overshot that intrinsic value quite significantly, and looks overvalued, then we look to take profits. The traditional way of buying low and selling high. That's one way of taking profits. The second one is we bought into the stock again with a thesis and with an intrinsic value which is well laid out. But as we kind of go through the time frame over a period of time, we realize that some elements of the thesis are not playing out as well as what we thought initially. We have seen that happen multiple number of times in multiple stocks. Don't want to get into examples here since you've given me a time limit. But overall, when the thesis is not working according to plan, then we have to take at some point a judgment call versus a stop loss as to should we cut our losses here. That's the second way of scenario where we have to exit a stock, and once in a while those stocks do sort of come in the way. I find in those cases having a stop loss, maybe a hard one or a stop one or a soft one, does kind of keeps in oneself within the tram lines or within the discipline of overall sticking to the investment philosophy and not kind of having losses really overburden the portfolio. That's the second time when we kind of or the second scenario where we exit the stock. The third scenario is that particularly in scenarios like when we saw in last March, April, that some of our portfolio holdings are at a certain levels, but then there are others which have fallen significantly. So maybe our portfolio stocks are trading at $80, where our fair value is $100, whereas some of the other stocks have fallen to maybe $40 or $50. So there's significant value available on some parts of the market, which fits into your philosophy. But it is just that they were not available earlier. They have opened up now, courtesy the market movement. In such a scenario, we might have to sort of take a call of exiting some of our existing holdings to buy some of the more undervalued ones. And that's another time when we kind of exit the stock or maybe book profits in a particular stock to move on to a scenario into another one. So those are the three scenarios in the way we think about exiting stocks or booking profits or shall we say booking losses in our portfolios. Hope that answers. I think this time you are on mute.
Yeah. Sorry. Can we have Sachin answer this question, please? How do you exit?
Yeah, so Sankalpo, again, similar scenarios I would say. So first is where I would say where the prognosis has actually not played out, right? I think that is where the real art or learning or experience or the tough call, what we call, it actually comes into play, because like earlier Mitul mentioned that it's all about avoiding mistakes. But the point is that once you realize that you've done a mistake, there is no way of 100% avoiding mistakes. But I think the key thing is, once you realize that you have done a mistake, that's the time. The earlier you bite the bullet, the better, right? Because and sometimes it's not only about your mistakes. It's also about the entire prognosis that you were anticipating did not play out because of multiple reasons. There could be sometimes the external challenges, like a COVID kind of a thing. But that has completely impacted so many businesses, right? It was completely out of the box. Or say, sometimes it's the internal challenges, right? A key person challenge, a key man risk, something of that sort. or there is a huge disruption from the other side of the businesses which you had not seen, right? So there could be many of those reasons which can really impact your prognosis that you were thinking. But once you realize there's a mistake, earlier you take action on it, it's always much better, is what has been the biggest learning, I would say. That's first. Second, in terms of the valuations, I think there is always, I mean, when your stock is done well or your business is done well, I think there is always this thing that whether you want to sell it, whether when it's fully priced, or would you like to wait for, you know, the obnoxious kind of valuation, or would you like to wait for euphoria? Let's me put it that way. Whether would you like to sell when it's fully valued, or whether you want to wait for euphoria. So I think there again an art comes into play, that if you have a business where to my mind, which is very top pedigree in terms of either the management quality or the inherent strength of the business, both put together, I mean, both of them have to be there, not only one, then sometimes it might be better to hold on, because you cannot see everything what's lying ahead. And probably the big picture is even bigger than what you are anticipating. But in certain businesses which are not absolutely great quality or anything of that sort, and you know that they are not like the triple A, they are like the double A or maybe the A plus kind of category. I think when you get a fully priced kind of over there, it makes probably sense to book profits. And the third scenario for us is that keeping the allocation discipline. Generally we like to keep the winners, you know, as they say, keep your winners and sell your losers. And that's something what really helps in the game of compounding. I've been talking about compounding, but the whole fun of compounding is you to keep on riding your winners. But still at the end of the day, you need to have certain allocation disciplines, and that is something what we strictly follow to. So even if a particular business is doing extremely well, and even if I believe that it's going to do even better in the next few years, but if it crosses a particular threshold of my portfolio, so if it crosses a 15%, 20% of my portfolio, if I had allocated only 7.5% to that stock, but now if it's gone beyond 15% or 20%, and if it's a large cap, I would like to trim. If it's a small cap, if it goes about 10%, 12% also, I would like to trim it to say about 8,
Right.
9, 11%.
Sachin, in the interest of time, I'll have to cut you there. So Mitul
Sure.
and Madan, we will ask you a different question because we are running a little short on time, and we've got a couple of minutes to answer this question each. If you had to select one kind of philosophy going into the future for the next 5 to 10 years and want to build a portfolio, what would that be? Maybe Mitul, you can take that, and Madan, you can then follow up that answer. So we've got a couple of minutes each to answer that before we have to wrap this up. Over to you guys.
Sure. So I think it's going to be, and I think it's going to be growth, and growth at a reasonable price is something that we are quite focused on. We are focused on over the last 3 to 5 years as well, and the future, I think we'll kind of do the same thing. So yeah, I'm going to keep it short. So I think growth and growth.
So, but you will maintain a part of your portfolio that also takes bets that that different philosophies might play out at different points in time, right?
Yeah, but we won't be buying like value just for the sake of value. Value
Right.
with a catalyst of growth is fine, but we need to actually see that that'll take place.
Right.
But otherwise,
So,
yeah.
So I agree with you. Probably 20s were a great time in the US to buy guard kind of a stock situation. So Madan, we'll take an answer from you on what is your go-to philosophy for the next decade.
So it depends on the investment horizon. Since you have mentioned this is a 10-year sort of a view, and it's clearly growth that matters. I think markets in the long term always align itself to the earnings growth of companies. In the short term, yeah, you get chances for value play like the one which happened last year when a market got disrupted heavily, and those kind of plays based on flows tend to happen. But in the long term, markets you have seen always matches with the earnings growth of that companies. And I think growth helps. And the last 10 years, you can see clearly, not just in India, globally also, growth oriented companies have delivered a good returns to the investors. Many factors here are under our control rather than a value-based investment where a lot you have to sense on the investor behavior, how irrational market is, and these things are definitely not my cup of tea. What I can really put a lot and what is there in my hand is understand the business, understand the growth prospects, and whether look at the financials and justify whether the company is able to generate cash flow to make use of that growth prospect. and invest into it, and be patient about getting the return out of it.
Right. Thank you, Madan, for that. Thank you, gentlemen, for being with us today. And I've learned a lot about investment philosophies, a bit about exiting, a bit about choosing the right kind of philosophy, and also a bit about how to play out modes. That was very insightful. So that's it from my side, Aishwarya. Thank you all for being with us. Thank you to the audience. Over to you, Aishwarya.
Thank you. Thank you.
Thank you.
Thanks. Have a
Thank
nice
you.
evening. Thanks. Bye.
Thank you.
Thanks, everyone. Bye.
Thank you very much, Mr. Pal, for steering that wonderful session. And we had such eminent panelists enlightening us. I'm going to thank them all once again. And with that, is going to be moderated by Mr. Kamal Manocha, ladies and gentlemen, who I'm going to be introducing a little more elaborately after a short break, because we have to get all the speakers on. All right. Ladies and gentlemen, I'd like to thank our eminent panelists. I'm going to also thank Mr. Pal for that wonderful session. But let me now, at this juncture, introduce to all of you the theme of the next session, which is last time.